Hello, hi. Hello, everyone. Welcome to our seminar. And good evening, everybody. If you're in the room, can you please say hi to me? It has been a long time since we have this Facebook Live or YouTube Live. Okay, so today we are going to present to you some of our research, some of our opinion. Of course, do treat it as a reference. And if you're in the stock market, I guess, okay, a lot of you are giving up on the stock market, right? So the thing is today, I just want to take a so-called a survey. Okay, how many of you have actually given up on the stock market? Okay, that's why we have this headline. Okay, we have this headline. It has been a thoroughly bad half a year, right? So yes, okay, the so-called the stock drop has started ever since beginning of the year, somewhere around December period, January period, and a lot of stocks has declined, especially in the US stock market. Okay, so a lot of growth stock, especially the growth tech counters has dropped more than 70%. There are so many category stocks have dropped more than 70%. Even the big cap counters stocks like Amazon, it has dropped more than 40%. Facebook, okay, which changed the name now is Meta, okay, has dropped 50% its value. Even the big cap stocks is being slaughtered in the stock market. Okay, so I guess it hasn't been a good time for all of us. But going forward, okay, in the second half of this year, today I'm going to share with you some of my opinion. Okay, so if you're in the room, can you please say hi to me? I can see Edwin is here, Jean Chua, Kenneth, Joe, Dylan. Okay, thank you for coming to our seminar. Okay, Alfred. Let me see, Jeff. Okay, Chun Wei. If you are in the room, please say hi. Okay, Kelly, Vincent, Peter. Okay, Brandon. Hi, all of you. Okay, today we have almost 200 of you that are in the room. Okay, currently in Facebook Live there are around 216. Okay, 216 of you. Peter. Okay, Lenny Lento. Okay. So I guess, okay, compared to our last Facebook Live, if some of you remember or you have joined before, is in March. Okay, yes, for the last 3 months, we did not have any Facebook Live sessions. The last is in March, if I'm not wrong, end of March. Okay, and you know what? That day our attendance reached almost 700 people. There are 700 investors in the room. Okay, so today roughly there are around 214 now. Okay, 240. It means what? Okay, it means that 500 is gone. Okay, most likely they have already given up. Okay, then they'll stop listening to you anymore. Okay, I don't care about you anymore. So most likely they have already given up, or a lot of our stocks are stuck. Okay, but this is what I want you to take note. I've been playing stock market for many years. Okay, I always treat how so-called people react to the stock market. And when the day a lot of us give up on the stock market, it does mean that bottom may be near. So today, that's the reason why I would like to have this seminar to prepare for you. What if in the second half of this year, okay, instead of all the recession and inflation fears, if everything subsides, will there be a chance the stock market has a rebound? There might be. Okay, so later I'm going to share with you some of my opinion. Okay, if you are in the room, please say hi. Louis, hi. Mac, Kevin. Okay, thank you for coming. So before we get started, I guess now US stock market is already open. US stock market open at around 9:30 p.m. Okay, so let's take a look at how S&P 500 is today, right? So as you can see, what happened last week, it hasn't been really good, okay, or 2 weeks before, because there has been a great fear that Federal Reserve will increase interest rate faster than what the market thinks. And that's true enough. Interest rate has risen last week by 3 okay, by so-called 0.75 basis point, okay. So if you take so-called one raise to be 0.25, they have raised so-called raised interest rate by 3 times, okay. So it has been one of the largest raise for almost a decade, okay, more than a decade, okay. So let's take a look what actually happened. To interest rate, okay, I always if I want to go to see what the economic report is, I always go to this website. It's called forexfactory.com, okay. And last week, Federal Reserve has a FOMC meeting, and in the FOMC meeting, they actually increased interest rate, okay, to 1.75 percentage, okay, to 1.75 by almost 0.75 percentile, okay. So let us take a look. As you can see, here there are two so-called figure, right? One is the actual value of Federal Reserve, the FOMC, so-called the Federal Funds Rate. The other is the forecast, okay? So the thing is, before last week, analysts is forecasting that interest rate might rise by around 0.5 percentile to around 1.5%. But instead, interest rate rise faster than what people thinks or what the analyst thinks by almost 0.75%. Okay, and that's the reason why 1 week before that, the stock market react to it. Okay, so that's the reason why we have this sharp fall. So S&P 500 from almost 4,200 point in just a span of a few days, it dropped to below 3,008. And the fact is, in mid-May, I thought that 3,800 point will be the bottom of S&P 500. And why is it 3,008? Because it's a 20% drop from the peak. Okay, I always say, in a bull market cycle, whenever the index dropped 20% from the highest peak, so if the highest peak is 4,008, you take 4,008 to multiply by 0.8 factor. Okay, that is what we call a 20% drop. You get a figure of somewhere around 3,800 points. And that is when I thought that that was the bottom. Okay, around mid-May time. Okay, so in fact, at the time, if some of you come to my physical gathering, I would say it's time to really look at some good, so-called fundamental, strong stocks, especially the mega tech counters, okay, like Amazon or even Google, okay. And true enough, following which it actually reacted, okay, and there is a so-called a bit of rebound, right? But then again, because of this interest rate fear, and it has got to do with, of course, the inflation, it's getting out a bit out of control, and that's when people are expecting a much higher rise in interest. And true enough, okay, so some of the Wall Street traders, they are right, so increased by more than 0.5%, right? And that's when the market actually react, and it so-called break the very strong support, I would say, of around 3,800 points. But then again, it dropped to somewhere around 3,006. Today we are still back to 3,800 point again. Okay, 3,800 point again. So this is my take for you. I always take 3,008 as a benchmark. If you have bought in some stocks after a 20% correction in the S&P 500 index, I would say hang on. Okay, you don't have to fear because you are buying at a cheap price, right? If you buy Apple somewhere around there, if you buy Amazon, so-called Microsoft, hang on to your shares. Don't worry, okay? But try not to add on more positions, okay? Because it will strain your portfolio. But in the next few months or few weeks, if you see it goes above 3,800 points strongly, if there is a big momentum boiling, right? You may always add in more position, okay? So I'm looking for some momentum play from now onwards. there need to be a strong reaction. There need to be a strong rebound. Okay, and that means you need to look at sometimes the candlestick chart, the price pattern. Okay, so is there a strong candle? Is there some volume? Okay, during the up days. Of course, from here, as you can see, okay, how do you know the market has turned positive in terms of momentum play? Always try to look at the volume, okay, for that particular day or particular session. If you see during the up day, if the green bar candle, okay, compared to the down day, the red bar candle, if the green bar candle in terms of the volume is higher than the red bar, generally it may mean there are more buyers than sellers. So from here, during this so-called a bit of what we call the panic, and it has got to do with the interest rate, the inflation fear, okay, you can see generally at this juncture, the red volume normally is higher than the green volume, right? Especially on these two down days, right? It's higher than this up day, followed by a higher red volume, followed by two lower green volume, right? And a slightly higher red volume yesterday. And today is a green day. We don't know whether it will so-called close at the green candle. But generally speaking, the buying momentum hasn't started yet, okay? But this is my prediction. Going forward, we will have what we call the second quarter earnings. I want you to really take a close look. My feeling, okay, is that there might be some positive expectation volume. There might be some positive surprise going into the second quarter earnings. And if some of you will know, okay, it's always important to so-called focus on some what we call a good earnings report that really give you a positive surprise. That means they make more money than what the analyst thinks. Okay, so later I'm going to give you some evidence. I do have a feeling that this second quarter earnings might not be that bad at all. It might even surprise the analysts. It may even surprise Wall Street traders. Okay, so later I'm going to share with you some facts. Now, before that, I also want to share with you an indicator that I always fall upon to know whether that month is bullish or bearish. And in March, similarly, I touch upon it. This indicator is what I call the CRS indicator. It stands for Cash Ringing System. Okay. In fact, some of you in the room today, most likely you are our graduates. You may have already heard of this indicator. So every month, what I would do is I would keep track of the first few days of the month. If during the first few days of the month, it falls above, okay, that means it is above the two lines of the month, I call it the cash ringing system, is considered a bullish month. So if it falls below the two lines, it's considered bearish month, okay? And true enough, okay, let us take a look at what happened in June, right? So let me so-called enlarge this area, okay, to look closely into June, okay? So you will see these two dotted line, one is in gray color, one is in red color. So this is the first dot of the month in June, which is the 1st of June, right? This is the 2nd of June, the 3rd of June, subsequent days, okay? So in the first 4 days of the month, okay, if it's touching the two lines, I call it uncertain trend, right? It needs to be above or below the two lines, okay? So if on the on the 4th day is touching the two lines, okay, what I will do is I will look for subsequent day. So you can see on the 5th trading day is also touching both lines, either lines on the 6th day, 7th day, and 8th day, okay? So on the 10th of June, it actually falls below the two lines, right? It goes into what I call the bearish zone, okay? So that signifies that June is still a bearish month, okay? It's still a bearish month. In fact, S&P 500 has been bearish for a few months, okay? Especially since March, okay? So March is a bearish month. Sorry, April is a bearish month, May is a bearish month, June is a bearish month, okay? So what I want is hopefully in July, whereby the second quarter earnings season kickstart, the good positive earnings surprise is going to pull the stock market back up. Okay, hopefully at the start of at the start of July, hopefully it turn bullish. Okay, and hopefully there's a chance the index is above the 2 lines. Okay, so that will be an indicator I always fall upon to roughly know, give me an indication. It may not be 100% right, but it give me the confidence that there is a bit of bullish momentum body, which is very, very important now. Okay, the stock market has been dropping crazily for many months. Okay, almost 6 months. You talk about tech stock, it has dropped for almost 9 months. Okay, ever since fourth quarter last year. Okay, so you need a bullish momentum to kickstart. Okay, to kickstart this bull market again. Okay, so there are a few things I always look out for. One is the price action. Okay, the price action. Okay, it must tell me that there's bullish momentum. Okay, there must be a bottoming forming, right? Okay. Number two, I always look out for strong volume on up days compared to the down days. It must tell me that the buyers are buying into some of the stocks now. Okay, so ever since okay, you can see, okay, the last 1 month, the red color candles are always higher in terms of the volume compared to the green color candles, right? So there must be a turnaround. Okay. Number three, I also want to know at the start of every month, how is the trend like? So hopefully in July, there's a turnaround using my CRS indicator. Hopefully it starts in the bullish zone above the 2 lines. Okay. So these are some indication that may tell me that stock market is about to turn around. Okay. Now, by the way, now we have currently 400 of you in the room. Okay, 400. Okay, so I guess only 300 give up. Okay, instead of 500, now only 300 give up compared to March. Okay, compared to March. Okay, so good. Okay, that's a good stat. Okay, at least half of you are still around. Okay, in the stock game. Okay, so now let us take a look at what. Okay, so I've done with so-called sharing with you some of my opinion, okay, about the general outlook in terms of chart analysis, okay? But this is what I want to share with you, a bit of disclaimer before I really give you some of my opinion, okay? So I would like you to do something, okay? Do your own research, okay? After this 1 hour of sharing session, okay, what I always say may not be right? So I'm not God, okay? But through my experience, okay, I hope that I can add value to you. I hope that I can provide you some so-called research, okay? So in the end, you still need to make your own decision whether you want to buy or sell any stocks, whether you want to buy into this so-called this downtrend, or whether you want to so-called sell away some of your shares, or try to increase in terms of your position, okay? So most importantly, do your own research, okay? So a bit of disclaimer, okay? Now, I would say the most important fear in the market today in Wall Street, okay? There are 2 of them. One is the high inflation we are in, okay? The other is the possible recession, okay? So a lot of government today come out to say possibly in the next 1 to 2 years, there might be some recession. Okay, there might be some recession. Okay, we cannot eliminate this fear. All right, we cannot eliminate this possibility. Why? Because interest rate is rising more than what people are expecting. Because you are talking about an inflation figure that is at a 40 years high. Never in the last 40 years we have seen inflation figure reach almost near to 9%. Okay, 9%. Okay, so that's the reason why even Singapore, okay, our PM Lee came out and shared there is a possibility in the next 2 years there might be a recession. Or even IMF is talking about it. Okay. one thing I want you to know, why the politicians do this, because to get yourself prepared. That's number one. Number two, to give you a reason why, okay, for example, okay, our PM Lee need to increase our GST, okay, need to so-called to warn you, okay, that there is a possible increase in terms of prices, okay, in terms of oil price, in terms of property price, in terms of a lot of goods and services, okay. They really hope that you don't blame them. Okay, take a look at what happened to Sri Lanka, okay. If some of you might know, the government is already under huge pressure, okay. It even caused one minister to commit suicide. What's the reason? Because of Sri Lankans are so fed up with the government, with the rising inflation, okay. They cannot afford their housing, they cannot afford their rents, they cannot afford this, they cannot afford oil, they cannot afford this, everything, okay. Even food is a problem in Sri Lanka today. It will create a lot of hazards, a lot of riots, okay, a lot of displeasure to the government. And we know government is all about gaining popularity, it's all about gaining votes, okay. So if Joe Biden do not come out and say something about that, okay, about inflation, okay, definitely he won't get the votes. He will lose the midterm election. By the way, there will be a midterm election somewhere around November, okay. So a lot of government come out to say, okay, and some of the government even give stimulus measures, okay, and this is not even about COVID, okay. They give stimulus measures, okay, to help the business. We haven't fallen into a recession, but Singapore is already printing almost $1.5 billion, okay, to help who? To help the so-called the people who are selling chicken now, right? They got no business, okay? To help the taxi drivers, to help this, to help that, okay? So hopefully to make peace, okay, with the public, okay? So that is the role of the government. But has any government officials come out to say that there is a very, very good chance there will be a recession? No. In fact, no government officials will do that, okay? They will tell you perhaps 1 year, perhaps 2 years, okay? I really don't know, okay? But there is a good possibility today, okay? Now, let us take a look at who really know this game, okay? Who is the best person to tell you whether there is a recession? I would say it's not Joe Biden. It's not our PM Lee. It's definitely not Daniel Low, and definitely not the analysts that appear in CNBC that tell you there's a good chance there will be a recession. So who is the guy that perhaps know the answer better than you and me? Anybody guess? Okay, so please put down, okay, in the perhaps in the Facebook page. Let me share with you later the answer. Thank you, Alan. Alan said it's the Fed, right? Correct. Most likely it's the Fed, the Federal Reserve Chairman. What's the job of Federal Reserve? Basically, they need to study a lot of economical reports. Okay, so Federal Reserve is basically a body of many members that represent different banks in America. So there is the so-called Central Bank of Philadelphia, right? There's a central, there's a so-called the Bank of New York. Okay, so what they will do is they will gather together every 1.5 months to discuss, is there a possibility of a recession, to discuss what the economy is. And do they only take a look at what happened to US? No, they will take a look at what happened to China, what happened to Asia, what happened to Europe, and they will come up with a consensus. Is it the right time to increase interest rate, to drop interest rate? Okay, so the best spokesperson or the best person you want to go to know whether there's a recession will definitely be the chairman of the Federal Reserve, the Fed, okay? And his name is, of course, Jerome Powell or Jerome Powell, right? So, let me share with you, okay, some of the words of the Federal Reserve chairman. He spoke last week, okay, after the Fed, the Fed meeting, the 2 days Fed meeting, okay? He said these words. He said recession is a possibility. Yes, you can't deny the fact, okay? It's a possibility, but not likely to occur. It is not likely to occur, okay? So let's take a look at what he said, right? So that's the headline, by the way. That's the headline, okay? Jerome Powell says recession is a possibility, but not likely to occur. Okay, not likely to occur, okay? And this is not what Daniel Low is saying, okay? This is what the Jerome Powell is saying, okay? So let's perhaps take a look at what he says, and later I'm going to share with you some of my opinion, okay? So Federal Reserve Chairman Jerome Powell says that central bank is committed to regaining control over inflation, okay? So the most important thing is now is a matter of decreasing the inflation rate. And by the way, how do you know what's the inflation rate today? Oh, so I always go to Google search engine and type in the words inflation of US, okay? And you will get a lot of so-called websites. Just go to one of them. So I like to go to this website called the tradingeconomics.com to take a look at the inflation rate of US, okay? So I'm taking a look at what we call the inflation rate, the annual inflation rate for that particular month. So basically what it means, the inflation is that they are comparing month against last year, the same month, okay? So the inflation for May, the figure for May, okay, is that it reached around 8.6%. Of course, it actually is what we call a 40 years high figure, okay, 8.6%, okay, 8.6%, okay. The thing is, in April, it actually dipped a bit, from 8.5 to somewhere around 8.3, okay, but suddenly in May, it shoot up, okay, to somewhere around 8.6%, okay. That's the inflation figure we are talking about, okay. So definitely Federal Reserve, they need to do something. They need to do something. They're under pressure to increase the interest rate fast enough to fight against this inflation figure. But this is my question for you. Okay, this is my question for you. Why is it Federal Reserve says that we are going to increase interest rate fast, but yet they think that recession is not likely, right? Most likely, my opinion is that they are doing a show. They are doing a show to let people see, and especially the US voters. They are doing a show to the US voters to tell the US voters, please vote for me, okay? Please vote for the Democrat Party, the incumbent party, at the end of the year. So Joe Biden may be pressuring the Federal Reserve to do something, okay? So a few months ago, Federal Reserve says, maybe we wait and see, right? We wait and see how is the figure like. Perhaps there's a chance it may taper down. But then again, what happened, right, in the last few months? There's what we call the Russia war. But bear in mind, okay, that Russia war, a lot of fear has already tapered down quite a lot, right? Then in April, China went into a semi-lockdown, right? Especially Beijing and Shanghai, okay? But of course now it's already opened up, especially in Shanghai, okay? So temporarily it dips a bit, then it suddenly shot up. So my guess is, one part of it is because of Russia war. A big part of it is because of Russia war. And a small part of it is because of China lockdown. So if you read what Tesla, Elon Musk is saying, right, today, right? Elon Musk is saying that we might want to retrench some people, okay? So in the end, of course, he get a backlash, right? Why would you want to retrench people when you're making money, right? So he said that it's because of China lockdown that our so-called, our materials, our goods is not able, okay, the supply of goods is affected, right? The supply chain is now stagnant, especially during the 1 month lockdown in Beijing and Shanghai, whereby their so-called, their factory is, okay, their giga factory is, right? And it has affected the other factories like in so-called California as well as in Germany, right? So they have a few mega giga factories to manufacture Tesla cars, okay? They are all affected. And they want to buy the so-called the goods, but they cannot get it because of the lockdown. So they need to pay a higher price, right? And labor today is a bit in what we call a shortage. And that's the reason why I feel that suddenly the last 1 month it actually shot up. So it's supposed to be tapering down a bit, but it suddenly shot up to the 40 years high of 8.6%. But this is my take for you. If interest rate over the next few quarters, if it keep on increasing, let me ask, okay, the audience here today, do you think there's a possibility that this inflation, instead of rising, it actually taper down? That means it drop over the next few months or few quarters, right? Because of the sudden increase in interest rate, is there a possibility that this inflation figure, instead of rising, it actually drop? Give me an answer. I'd like to take a survey. Yes or no? Do you think there's a possibility that it will drop? Yes or no? Okay? Let me take a look. Okay? Do you think there's a possibility that it will drop? Knowing that, by the way, your chicken is expensive today, right? You know that your property is today very expensive. And knowing in advance, because all government in the world is now warning its citizens, there might be a recession. There might be a recession. No government today is not coming out to talk to you, okay? There might be a recession, okay? They need to warn you, basically, because of inflation, okay? Most likely, they need to get the votes, or they need to warn you. Is there a possibility that you will cut down on your spending? The moment you cut down on your spending, what will happen to this inflation rate? Will it continue to rise, or will it continue to fall? Okay? Knowing that your petrol is expensive, would you like to control a bit on your expenditure on your petrol? Okay? Knowing that interest rate is rise sharply, okay, even if you want to buy property, are you a bit hesitant today? Do you think this inflation will continue to worsen, or it may drop, right? So let me take a look. Ma Yuxuan said yes, okay? There might be a chance it drop, okay? Okay, I think today is a bit slow, okay? So I can only see one answer. I don't know why, okay? So hopefully you give me some participation. That's when we learn together, right? Okay, never mind about that, okay? Yeah, it might even worsen, okay? Karen said it might worsen. Thank you, okay? So, I give you my take. I think that there is a possibility that instead of worsening, it might drop. It might drop, okay? So we might be hesitant to go for staycation again. We might be hesitant to go overseas. What's the reason? It's because we might be even hesitant to buy our Rolex watch, right? Knowing that something may be happening in the next few years. Okay, the government will already warn us there might be some recession, okay? So we might be hesitant in spending. And that's always one of the reasons that will cause inflation to taper down, okay? Because of expenditure. So, even if it worsen, I would say it's still okay. Okay, later I will share with you the reason why, okay? Okay, let's go back to this report, okay? Why is it that Jerome Powell says that there might be not a recession? Okay, let's take a look. Number one is he said that we need to get inflation back down to 2%. We're using all our tools to do that. And the public should believe that we can get the inflation back down to 2% over time, right? Okay, what Jerome Powell is saying is that he stressed that the economy is well positioned to withstand higher interest rate. Although he acknowledged that the war in Ukraine and the lingering supply chain problems increase the risk of economic slowdown. Okay, so we are not trying to provoke a recession, but we think that it's absolutely essential that we restore the price stability, really for the benefit of the labor market as much as anything else. Okay? So let me tell you a bit about history. Some recessions are actually what we call short-term. Some are prolonged recessions. Short-term recession, we call it a technical recession. Prolonged recession, it will really deeply affect so-called the debt. Okay, it will really affect, it will cause a strain to the banks. Okay, they might need to so-called wipe off their bad debt. Okay, it might even cause a lot of companies to fail. Okay, so there are two types of recession. One is what we call a technical recession. The other is called the full-blown recession that really hit the economy hard. Okay, that will cause people to be out of jobs. Okay. Now, let me share with you the situation about jobs today. Job is almost at the lowest point over the last 20-30 years. Job supply is so much that no companies in the world today is retrenching people. Right? No company. Maybe the first company I hear of this year is called Tesla. Right? But the main reason why Tesla want to cut down is because of supply chain. What if China open up its borders again? What if Beijing open up again? What if the factory open up again? There might be a chance that they no need to close down. Okay, they no need to so-called cut down on their workforce. They need to increase their workforce again. Okay, no banks today are retrenching people. No oil and gas companies is retrenching people. Neither are the tech firms. I haven't heard of a tech firm that's retrenching. In fact, Semicon is still doing quite well, right? So I would say that jobs is almost at the lower, unemployment rate is almost at the lowest point. There are a lot of jobs, but what's the problem? The problem is there are no workers working. The salary keep on increasing. Even the salary is inflating crazily in US. You want to find someone, you need to pay a higher pay. That's why the companies are complaining. So what they need to do is they need to taper down on the job market, okay, to decrease the salary today for the benefit. The increase in interest rate is for the benefit of the labor market. They want people to be so-called, they want the salary to be lowered down, okay? So what they say is the US economy, these are, I think, very, very important words. Why do Jerome Powell say that we can avoid recession? There might be a chance we avoid recession because US economy is strong. For now, it's strong. It's much stronger than whatever we think, okay? The spending power is equally strong. Consumers are still in good shape. Business are in good shape. And let me tell you something. If there is ever a recession in the next 1 year, I would say it will most likely be a technical recession. It will not affect the job market at all. Okay, now we are lacking in terms of workers. Okay, so businesses are still in good shape. People are still employing, businesses are still employing, and the consumer are still spending money. And do you know what? In June, I recently go to this Korea, right, for my holidays, 2 weeks of holidays. Okay, of course, I signed up with this tour agency called Chan Brothers. And when I go to Chan Brothers, okay, basically for me, I'm quite a busy person, so I need to plan my holidays in advance, right? So I'm asking Chan Brothers, okay, regarding some of my trips, okay, in the December holidays. I asked them, is there a so-called a tour, or can I get some so-called cruises, okay? I want to go for this cruise, okay? They say the cruise, you better sign up fast. Most likely by August, you'll be all over, okay? So that means you'll be all taken up. So by August, you need to sign up 4 months in advance. If not, you can't ride the cruise. You'll be all taken up. The seats are all filled already. So in fact, I actually so-called sign up for this Korea package, okay, quite late. So I almost missed the trip. He said that now businesses are so good, but we lack of Chan Brothers. We lack of employees because the last 2 years, a lot of employees go out and find a job and they don't want to come back anymore. So Chan Brothers has no agents now, okay? So the thing is now we are lack of staff. So in fact, they tell me that even part-time workers, okay, last time they pay $10 per hour, now they need to pay $12 per hour. 20% higher to attract the part-time staff now, okay? There are lack of staff, okay, because we are opening. So I guess the job market is still in very good shape. We are opening up the borders, okay? A lot of countries are going into what we call the post-COVID period. So most likely, there's still strong spending. Don't be afraid of that, okay? In fact, what the government want is you spend a bit less. You spend a bit less. Because when you spend a bit less, inflation is going to taper down, okay? So in the end, he said, okay, of course, the last sentence is, we have the tools, okay? We have the resolve, okay? And hopefully the judgment to accomplish the task of so-called getting inflation to be in control, okay? So that's the reason why he think that fundamentally we are not falling into a recession, although a lot of analysts predict, okay, a lot of bankers predict it, okay? But I guess from all the so-called the statistics, from all the so-called what the businesses are doing, from what the bank report is, there's absolutely no reason why you cannot pay for your mortgage loan today, right? Today, our so-called interest rate is just at around 1.75%. There's no reason in defaulting on your debt. And that's one of the fundamental reasons why perhaps we might avoid this recession, okay? But let me share with you something. What if really we fall into a recession? Do you think it's a chance to buy shares? So let us take a look at the 50 years history of US recession. This is a 50 years. I actually got this from a Hong Kong website. All right, I like to read sometimes Chinese news in Hong Kong. Okay, because they're more advanced and sometimes they have some data, some statistics that I like. Okay, so let me share with you something. In US, across the last 50 years, there are 5 major recessions. 5 major recessions. Okay. The first recession happened in 1973, okay, 1973 to 1974. That is what we call the oil embargo, okay, oil embargo, whereby at that period, at the time, Arab countries actually grouped together, they team up together and they don't want to sell oil to US. So US need to buy oil from other countries outside Middle East at a very high price. So that triggered one of the big recession in 1973. So what happened that year is that S&P 500 index dropped 37%. S&P dropped 37% in that year. But guess what? The next year, the following year, 1975 to 1976, S&P 500 index rebounded by 70%. 70%. Almost double compared to the drop the previous year, right? So in 1980s, if some of you remember, there was a period in time whereby interest rate reached 20%. You may not believe it, Daniel. Now we are still at 1.75 and people are still fearing about interest rate, right? At 1.75. If you visit 1980, which is 40 years ago, interest rate reached 20%. 20%, okay? And definitely it's going to trigger a big fall, right? You definitely cannot pay, if you buy houses at a very high price, you cannot pay your mortgage loan. That was in the 1980s, okay? Interest rate reached 20%. And today we are talking about 1.75 and people are scaring the hell out of them, right? So at the time, what happened? S&P 500 index that year, it dropped 5%. 5% drop that year. But what happened the following year? S&P 500 rebounded by 48%. 48% the following year. That's a performance for S&P 500, okay? Almost 9 times the drop, okay? 9 times the drop. Then what happened in 1990? 1990, there was a recession. There was a recession. And this recession is triggered by some war, okay? So what happened is, okay, S&P 500 that year dropped 3%. The following year, it increased by 40%. 8 times the drop. Is it 8 times? I think more than 8 times the drop, right? Almost 9 times the drop, okay? Then in 2000, if some of you know, that's the internet bubble burst, right? That triggered a worldwide recession because a lot of tech stocks, okay, crash. Okay, that was the day whereby it crashed. Okay, but that was a bubble burst, right? That year is so severe, a lot of people get out of jobs, okay, because a lot of people work for tech companies, okay, they can't find a job, all the tech companies cannot employ people. S&P 500 index dropped 37%. That is a really big full-blown recession. Full-blown, it's not a technical recession, it's full-blown recession, okay? It dropped 37%. But guess what? The following year, S&P 500 increased more than the drop in terms of percentile. It increased by 42% in 1 year. In 2008, there is again another full-blown recession, whereby a lot of banks, okay, got into trouble. I would say almost all the banks in the world got into trouble, even our DBS, right? JP Morgan, Morgan Stanley, okay, closed down, closed shop, okay? Even somebody that's insurance company that's related to banks, okay, I got into deep trouble, like AIG, okay, Citigroup, okay, so and so forth. There was a full-blown recession. S&P 500 that year dropped 37%. 37%. But guess what? If you buy during the drop, the following year, S&P 500 increased by 45%. 45%, okay? More than the drop. So it tells me something. Why should we fear about recession? Okay, in fact, recession is the best time to buy shares. Okay, you can bottom pick the shares you want. Look for shares that are fundamentally strong. Okay? So even if you buy, okay, maybe during the drop, right? You buy at 20% drop, okay, it dropped more than that, right? 37%, okay? The moment you buy, it drops some more, right? You just need to hold 1 more year. The next year is going to go up again to more than your loss, right? You cover your loss and you make much more. And following which, the next few years, it continue to go up because it's a full-blown bull market, right? So don't worry about recession. And by the way, the last half a year, from January until June, how much has it dropped already? How much has the stock market dropped already? So let us take a look at S&P today. 4,800 points. Of course, I thought that it would stop at 3,008. Like what I said, that's a 20% drop. Okay, so that means in 2022, it has already dropped. Okay, the lowest point it dropped to is last week low, which is 3,006. It has dropped exactly 25%. 25% drop. In a time whereby we don't know whether there is or there is not a recession, right? There's a possibility you can avoid recession. There's a possibility that inflation might be tapered down. There's a possibility that people are still having strong buying power. It's not the same as, okay, it's not the same as the subprime mortgage bubble burst, whereby a lot of companies are retrenching. No companies are retrenching today, perhaps except Tesla. Everybody, including the travel agency, is trying to employ more and more people, okay, because they can't find the staff that they retrenched in the last 2 years, right? Okay, and that is the so-called one report by an analyst, okay, in Hong Kong. Let me read out in Chinese, later I translate, okay? It is mentioned here, 分析家一直讲美国的经济 okay, 会衰退，但衰退对股市有什么影响？ So this is the question. Everybody thought about the economy is getting bad, it's going to affect stock market. But what impact has it on the stock market now? 不少人认为经济衰退 okay, 股市也必衰 that means a lot of people think that when the economy is bad, definitely the stock market will drop. 不一定哦 okay, it's not really true, okay? This chart here shows that ever since 1973, 美国的经济每次衰退时，美股的表现过后是不错的。 So that means ever since 1973, whether is it a big full-blown recession, whether is it a technical recession, no matter what recession, over the last 50 years, okay, every time there's a recession, the stock market gets stronger the following year. It gets stronger and better, okay? And the fact is, we have already dropped 25%, okay? So if you take a look at what happened during the recession year is on average, if you track the performance, okay, in 1973, S&P 500 dropped 37%. 1981, it dropped 5%. 1990, it dropped 3%. 2000, internet bubble burst, it dropped 37%, right? 2000, subprime bubble burst, it dropped around 40%, so around 37%. But guess what? Today, we have already dropped, ever since January until today, 25% from the peak. How much more can it drop? How much more can it drop? Okay, at worst case, if next 2 years, you are all out of jobs, we go into subprime bubble burst again. At worst case, all the banks get into trouble. Okay, what I want to share with you is definitely, there'll be a lot of money being printed again, okay? So, what I want to share with you is, based on these statistics, the worst case is it will drop on average, okay, 37%. We are almost 10%, another 10% away from the average drop, right? What I mean is, if you consider the largest drop in the last 50 years, which is 37% that year from the peak, right? We have already dropped 25, another 10% more or 12% more, and that's it. Okay, that's it. Okay. But what if it doesn't drop another 12%, and from now the stock market start to rally up again? So of course we are not God. Okay. What I really want you to note is there might be a chance the stock market can avoid this recession. And this drop is not a recession, it's not a bear market, but rather it's a corrective phase in the bull market. There might be a chance this 6 months is a correction. It might not even be a bear market, right? And furthermore, I just want to share with you something, okay? Increasing interest rate, is it really bad for stock market? A lot of people think that increasing interest rate, the stock market will be dead, right? Companies can never survive. Google will never be able to make the earnings it's expected to make anymore. Not really. I would say not really. Okay? Let us take a look at what happened in 1994 during a span of 1-2 years, whereby Alan Greenspan, the XXX Fed chairman, his name is called Alan Greenspan, in a period of 1-2 years, increased interest rate by 7 times. 7 times, okay? So let's take a look at this article, okay? So after the last week rise of 0.75%, which is unheard of ever since 1994, I think, okay? The largest increase in interest rate by 75% or 75 basis points last week, okay, is the largest hike since 1994. Okay, so people are comparing what Alan Greenspan did that very year to what today Jerome Powell will do, right? Increase interest rate very fast over perhaps the next few quarters, right? So let us take a look what happened. Okay, the actions over the last few days from the Federal Reserve bring back memories of 1994. 1994. That was the year whereby, okay, Alan Greenspan announced a new target range of between 1.5 to 1.75%. Sorry, that's not what Alan Greenspan said. That's what Jerome Powell said. Okay, so today our interest rate is at 1.5 to 1.75, right? So, okay, let's take a look at what happened in 1994. Alan Greenspan, Federal Reserve, okay, at that time raised interest rate by 7 times in a 13 months period. 13 months period. That means almost every 1 month increase 1 time. 1.5 months increase 1 time, 1.5 months increase 1 time. Okay? In 1994 to early 1995, in an effort to prevent an overheating economy from driving up inflation. Basically, almost just like today, okay? And that was the inflation rise, okay? So from almost a 3% rise, okay, it rise to around 6%. 3 to 6% is around a 3% rise in terms of interest rate, okay? So the interest rate, it double up, okay? It double up that 1 year, okay? But I want to share with you what happened to S&P 500 that year when interest rate rise so suddenly. The stock market rallied in the aftermath of the Fed's aggressive rate hikes. The S&P 500 index and the Dow Jones Industrial Average climbed 36.6% and 42% respectively between the start of 1994 and the end of 1995. Okay? So does it mean that interest rate rise so drastically to fight against inflation? Does it mean surely the stock market will crash into a bear market? Not really, if you take a look at what happened in 1994, okay? After the final hike in the 1995, the stock market rallied further. It rallied further, okay? The only thing about fast rising interest rate environment, I would say it will impact the bond market more than stock market. Or generally speaking, it will affect bond market more than the stock market. Why? Because increase in interest rate means that the bond yield rate will rise sharply, right? So once bond yield rates rise sharply, it's a so-called a seesaw, right? The bond prices will drop, okay? So in 1994, what happened is a lot of funds get out of bond market and they go into equity market. So there's what we call a fund flows, okay? The fund flows from the bond market out and go into equity market. In fact, that was one of the best year of, okay, this stock market. So the Dow Jones Industrial Average climbed, okay, 42%. S&P climbed 36%, okay, during the hike, okay. So what I want to share with you is there may be a possible chance that once you get used to it, get used to what? Rising interest rate environment. For the last 2 years, people are borrowing money crazily. Businesses are borrowing money crazily to go and buy crude oil, to go and buy soybean, to go and buy the commodities, okay? Property developers are borrowing money crazily to develop, okay, to buy land, to develop their so-called their projects, okay? Retailers are borrowing money crazily to go and buy properties, okay? Some even go and buy Rolex watches, okay? All the luxury items you can get your hands on. Cryptocurrency went berserk, okay? So all this is because of, okay, the easy money that we can get. And there is always a reason after printing almost $10 trillion, okay, over the last 2 years, we are a bit scared about interest rate rise, right? We are a bit scared because we are buying properties, we are buying all this stuff, right? Or even businesses, okay, they are playing with futures, playing with oil, playing with natural gas, playing this and that, okay? So that's why there is a bit of fear. But then again, does it mean that every time there's inflation, does it mean that every time the economy gets better, there will be a full-blown bear market? Not really. If not, okay, bull market will never survive 10 years, right? The moment inflation comes up, economy gets better, we get out of subprime, 2 years later, there is a crash, right? It can't be. So normally what we do is there will be definitely some correction along the way. So one of the reason I feel, okay, hear me out. One of the reason I feel that this year is so bad, is because from 2020 March, the stock market has been running non-stop. Not only the stock market, every market in the world, be it the crypto market, okay, the luxuries item market, or so-called the Bitcoin market, okay, the crypto market, the property market, every asset classes has gone up crazily over the last 1-2 years. And to me, this is not a bear market over the last 6 months. This is a correction in amid the bull market cycle. Pardon me, that's my opinion, okay? I would say this may be a corrective stage amid a 5 years or 4 years of bull market. And trust me, the only reason I feel that the last bull market can sustain for 12 years. Okay. So what happened is, ever since subprime mortgage bubble burst, okay, let me go back. The bull market lasts for 12 years. From 2009 to 2020, right? It's one of the largest bull market we have ever witnessed in terms of duration. This was 12 years of bull market run. And one of the reasons why this bull market lasts so long, okay, one of the major reasons is along the way, there are a lot of correction. Okay? So without this correction, this bull market will never be so sustainable. If suddenly the bull market keep on running, okay, Dow Jones reach 50,000, that's it. We are going to go into a bubble burst. Okay, so there at some stage in the bull market, there needs to be a correction, and some correction lasts for 6 months indeed. What I want to share with you is, in 2010, there is a 6 months correction at this stage. In 2011, again, there's almost a 6 months corrective stage, okay? So along the way, in 2011, we have something called the Europe crisis, right? So at the time, Europe, okay, went into deep trouble, okay? A lot of banks almost declared bankruptcy, even Deutsche Bank got in trouble, okay? Greece is almost bankrupt, okay? So there was a period in time whereby the whole world is so afraid, okay, that we are going to fall into another recession fast. I would say it's almost just like today. After the COVID 2 years later, people are so afraid that another recession, we call it a double dip recession. That means the last recession and this recession is so near to each other, we call it a double dip recession. It may be a span of 1-2 years, okay? But then again, we avoid that recession, even amid the Euro crisis in 2011. I would say that year was even more fearful. The stock market was even more fearful than today. Why? Because the whole Europe go into deep shit. They don't have much money anymore. Okay, a lot of people who borrow money to buy properties, they cannot pay up anymore. So ECB, okay, European Central Bank, need to print trillions and trillions of dollars just to save the property market, just to save Deutsche Bank, just to save ING, just to save all these banks in Europe. That was even a more big turmoil, I would say, compared to today, what we call the inflation fear, right? And the business are still going well. Okay, the bank is not declaring bankrupt, okay? But because of all this trouble and turmoil, okay, that this bull market keep on sustaining and keep on running, okay? So of course, I'm not predicting that this bull market will be as long as 12 years, just like the last round of bull market run. But my opinion is fundamentally the business are still strong. Google is still making money. Apple is still selling well, right? Tesla, it's not because they can't sell that they want to retrench. It's because they are running out of labor. They are running out of product because the factory need to close down for almost 1-2 months, okay? So the supply chain is getting stuck somewhere. They cannot unload the goods, okay? So it's not because there's lack of demand of goods and services. In fact, there's strong demand still. There's still buying power. So I would say that this recession fear may not be as big as what people might think, right? Okay, let me come back to my PowerPoint. Okay. So will there be a chance that, okay, in the next few months, okay, instead of going down further into a full-blown bear market, is there a chance that it might start to go up again? And along the way, maybe it go up 1-2 years, it drop again, then start to rally again, okay? This is what we call correction amid the full-blown bull market run, okay? And let me tell you something. today I want to get yourself prepared, okay? I know it's really bad times, but look at the bright side. It's because of this drop. The expectation today has been at rock bottom. It has been at rock bottom, okay? So I want to pay attention to the July period, whereby a lot of companies, especially in US, all over the world, will start to declare its second quarter report, okay? Second quarter report, okay? So this report I actually download from this website. It's a very good website, very informative in regards to telling you what is the earnings like in America, okay? It's called the FactSet, okay? FactSet, okay? So I just want to share with you. Today, analysts, when I say analysts, I do mean the Wall Street analysts. It's not common folks, okay, like you and me, huh? The analysts today continue to have an unusually high number of buy ratings on S&P 500 stocks. Unlike what we have fed, right? A lot of people think that now stock market is sibei jialat already. The analysts who are good in analyzing shares, I'm not talking about common folks, I'm talking about those geniuses, okay? Those, they are really, really good analysts, okay? They continue to rate S&P 500 stock as a buy rating, okay? Despite higher inflation, rising interest rate, military conflict in Ukraine, fear of recession, stock price declines, analysts continue to have an unusually high number of buy ratings on stocks in the S&P 500. I like to know this. I like to study what the analysts think. Because analysts, sometimes they do something called forecasting. Some analysts, like Bank of America, they will send their analysts to go down to Apple to go and know how much sales they can have for the following few quarters. And they will come out with a report to say whether it's a buy or hold or downgrade, right? Or sell, okay? So definitely you need to understand what the analyst is doing, right? So I guess they have already done their homework. So as of today, there are 10,000 ratings on stocks in the S&P 500 index. Of all these ratings, 56% of them say it's a buy. 37% said hold first. Don't buy first, wait first. Only 5% said sell now. Okay? The 5-year average percentage of buy ratings is 53.3%. And that means we are above the average. Okay, the buy ratings from the analyst is above average. Okay? Okay, let me share with you this. At the sector level, okay, can you read here? What are the sector you must concentrate on, right? At the sector level, analysts are most optimistic on technology stocks, which is the most badly hit across the last 6 months, right? A lot of tech stocks, the growth tech stocks, the Cathy Wood stock dropped more than 70%. Or even fundamentally strong stocks like Meta, Facebook, already dropped 50%, Nvidia, 50%, Netflix, 75%, okay? Apple, almost 30%, Microsoft, 30%, Amazon, almost 50%, okay? They are the worst out of this 6-month drop, okay? Of course, and that is where I would say the value is. It has dropped so much that it's undervalued, okay? Even the analysts know it, okay? Fundamentally, it's strong, okay? So what is driving this optimistic outlook in terms of the ratings? One possible reason is analysts continue to increase earnings estimate. They are not silly people, okay? They always continue to do something called forecasting, okay? So what actually happened is, this is not a full-blown bubble like internet bubble, whereby the stock market keep on running and running and running and running crazily until everything crashed. Instead, what happened is fundamentally it's supported by the earnings now, but then again, temporarily we are so afraid of a bit of interest rate rise because it's the largest rise in the last 20 years. And inflation that is now at around 40%. But then again, inflation may be caused by temporarily the China lockdown, as well as temporarily the Russia war. Have you ever thought that maybe one day the Russia war can simmer down, okay, if they reach a peace, right? So what will happen to crude oil price? And I would say most likely crude oil price, if there's a bit of what we call peace in terms of Russia and Ukraine, okay? If there's a bit of peace, crude oil might even crash back to $60 again. Okay. So basically, it means something. Our analysts already did their due diligence. They already do their valuation. Okay, and they think that now is a cheap. Okay, it's cheap to buy tech stocks. Okay. And let us take a look at the Q2 earnings numbers. Okay. Analysts and companies, not only analysts, but companies also, they have lowered their earnings expectations. As a result, estimated earnings for S&P 500 index for the second quarter are below expectations at the start of the quarter. The index is predicted to report its lowest earnings growth since Q4 2020, which is the lockdown period. Okay. So it tells me something. Okay, it tells me something. By the way, here is important also. This decline is wait, Okay, this doesn't tell the whole story, but never mind. Okay, what I want to summarize is a lot of analysts already downgrade the expectation, okay, in regards to the earnings, okay, whether it's Google earnings, Apple earnings, okay, or even Microsoft earnings, or even Palantir earnings, okay, Cathy Wood stocks earnings, okay. Basically, they already downgrade, okay, their earnings report, okay, their earnings forecast. So will there be a likelihood chance that the companies actually perform better than what the analysts expect in the coming 1 month, right? The second quarter earnings. I would say there's a huge chance there might be what we call a positive earnings surprise, okay? And I always like positive earnings surprise. So can you please write this word down? Whenever you buy shares, you always want to buy shares whereby there is a positive earnings surprise compared to what the analysts think. That means it supersedes what the analyst expectation is. That's where stocks can have a chance of gapping up, because all is not worse. Okay, all is not that bad. Okay, so there is a good chance that the coming earnings will tell you how resilient is this stock market reacting to the inflation and the interest rate rise. Okay, so what I want to share with you, you don't have to believe me. You don't have to buy stocks now, right? You don't have to add your position, because there isn't any positive momentum yet. Like what at the start, beginning of session, I already tell you, sometimes you need to read a bit of charts, to read a bit of volume, to know a bit of candlestick patterns, to know whether there's a positive momentum, okay? And positive momentum is always, okay, substantiated by facts. And one of the best things that Wall Street like to study is earnings announcement. Okay, whether you want to buy Apple or whether you want to buy Google, okay, does Warren Buffett, okay, if you want to buy Apple, does he look at, okay, perhaps economy more, or does he look at Apple business more? Okay, I would say a lot of them are still fundamentalists, right? They rather study how the market, how the business react, whether they are making money, right? So this is my suggestions for you, okay? It's very important to look at the second quarter earnings, especially after these 6 months of drop. It has dropped slightly, I would say it's slightly more than my expectation, a 25% drop in S&P 500, right? And I do expect 20% to be a bottom. It may be the fact that last week, okay, the interest rate rise is more than expectation. But my take is, how worse can it be? People are already so-called expecting the next rise in July to be 0.75. People are already pricing in the expectation that Federal Reserve is going to rise by 0.75. I don't believe this year Federal Reserve is going to rise by 1% in one FOMC meeting. Okay, so most likely next month is going to rise another 0.75. But people already expect it to happen. Last week already expect the next rise to be 0.75. So there may be positive expectations, okay? So there may be positive surprise going into the earnings period, okay? So expectation today is at its lowest point. Stocks may have what we call a positive earnings surprise. That means it will be more, okay, in terms of the profits, it will be more than what the analysts expect. I would like you to do something. Focus on those stocks that are inflation proof and is still having good earnings. Okay, what do I mean by inflation proof? Okay, let me share with you what is inflation proof. Do you know what? In the last few days, if some of you look at some Cathy Wood counters is the most badly hit in the last 6 months, right? A lot of stocks dropped 80%, 70%, just like that, okay? And this is one stock called Zoom, one of Cathy Wood's favorite, okay, in the top 10 so-called the ARKK fund, right? But I just want to share with you, yeah, this stock has dropped a lot from as high as almost $600 today. Okay, the lowest point it dropped to is around $81. $81. Okay, let's look at the daily chart, right, of Zoom. Last week, some of the stocks or even the index dropped to a low point. Okay, dropped to a low point. S&P dropped to a low point. But guess what? This stock, Zoom, is resilient over the last 2 months. The lowest it dropped to is $80. Okay, $80. In May, it was found to be around somewhere $100. Today, this stock is at $120. Basically, it means that the last 1 month, it actually appreciated from $80 to $120. This stock increased by $40 in the last 1 month, right? From the lowest point, $80. This stock increased by $40, 50% rise in price in the last 1 month. Guess what? Yeah, in the last 1 month, not all is bad, okay? There are some stocks that are so resilient, okay, that they are increasing 50%. And this is one of them called Zoom. There are a lot, okay? So, what I mean is, okay, looking at the chart, this is what I call the rounded bottom pattern, okay? One of the momentum play I like to know whether a stock bottom is near, is I like to see a rounded bottom pattern. Rounded bottom means that the volatility is already tapered down. It's not as fearful, the market is not as fearful as it was perhaps at the start of the year, right? So that's the reason why you can see, okay, the drop isn't that much anymore, okay? Maybe it dropped slightly, okay? Last week, because of this 0.75% increase in interest rate, it dropped slightly. Yes, inflation, it dropped slightly, yes. But how much can it drop? So this tells me that there is a what we call a rounded bottom, and there might be what we call a higher high pattern forming, right? Higher low pattern forming, okay? This is the last low. So what you can see is there is something like what we call an inverse head and shoulder forming, whereby this low is slightly higher than the last low. The lowest low happened in May, okay, happened in May. So amid all the bad news, this stock increased by 50%. And by the way, this is one of the worst hit stock over the last 6 months. The last month, it increased by 50%. It's more resilient than what people think. This is a Cathy Wood counter. Don't think all Cathy Wood stocks are C already, okay? This stock is good, 50% rise in price. What if in the next 6 months, what if because of good positive earnings, the next earnings will be coming out in August, right? What if in the next 6 months, okay, that it does rise to $160? I would say there might be some chance, right? I'm not eliminating that chance, okay? If it rises to $160, it does mean that it has increased 100% from the bottom. A 100% rise, okay? And what's the reason? It's because it has tanked sharply. Anything that drops sharply has a high chance of rebounding sharply too. Okay, that's the behavior of stock market. Because the expectation is already lowered down until cannot lower down. the next earnings, if it supersede what the lower down expectation is, this stock may have a chance of getting up. It's not as bad as what people think. Why isn't it as bad as what people think? Because it's inflation proof. Okay, the only sector that you need to be very afraid of, okay, are those sectors that's related to inflation, whereby it's going to cause its cost of buying raw materials to be very high, right? Stocks like Tesla, stocks like manufacturing sectors, whereby they need to buy a lot of raw materials, even energy companies, okay, some energy companies should be avoided now, okay? But you tell me, will it affect Facebook? Will it affect Meta? Will it affect Zoom? These are the stocks I call inflation-proof counters. That means no matter what, okay, yes, okay, maybe the cost of goods and services rise, but it won't affect that much. Okay, you still make use of Facebook. Okay, you still make use of Zoom to do your teleconferencing, right? You still need to pay for your services. You need to go to e-meetings, right? You still need to use Microsoft. You still need to use Google search engine. You still need to buy your Apple. In fact, Apple is one of the most inflation-proof stocks I ever seen. Okay, they just when inflation happens, they just rise by 10%. Okay, the Apple rise by 10% that year. Okay, and people will still buy Apple. Okay, because they got loyal customers. So these are what we call the inflation-proof sector. I would say tech sector is an inflation. Most of the tech sector are inflation-proof sectors. Okay, because they provide services online or e-commerce online. Okay, so those sectors that are not inflation-proof, property sector. Okay, property sectors, okay, is now badly hit because interest rate is going to rise sharply. So people are going to taper down on buying properties now. It's a wait and see thing. Okay, it's a wait and see thing now. Okay, import export. Okay, companies that's going to buy raw materials, goods. Okay, shipping companies. Okay, all this should be avoided. Oil and gas companies, some oil and gas companies, because they are either they're upstream, downstream. Sometimes you need to buy and refine. Okay, or semicon companies. Okay, so so tech, semicon. Okay, temporarily you try to avoid. Okay, but if you are tech in terms of providing services, okay, like Zoom, Twitter, okay, Facebook, I would say is more inflation proof. Okay, so I want you to do this. Okay, focus on the next earnings, which is the up and coming second quarter earnings, either in July or August. Focus on stocks that gap up on the earnings day. Please write down this word. A stock that gap up on earnings day means that the market think well about the earnings. And these are the stock you might want to put in a watch list. And if it's inflation proof, I would say it's a very good chance, okay, for you to buy really cheap. Okay, especially like what, not only me, like what the analysts expect tech sector to be a very good buy rating sector now, right? So watch out for some good tech stocks that perform well in the upcoming earnings. Okay. Okay. This is the spotlight on information technology sector. Okay, sorry, just now I already talked about this. Okay. Okay, that's all I want to talk about today. I just want to give you my own opinion. Of course, do treat it as a reference. I may be wrong. Not wrong. Okay, the thing is there might still be a recession. Okay, but my take for you is in the next 1-2 years. Okay, 2 years is so far off. Okay, if you are talking about a recession, a lot of banks are now forecasting. Even if there's a recession, it will not happen this year. It will not happen early next year. It will happen at the late third or fourth quarter next year. Okay, most likely the end of next year. Okay, and that is almost 1.5 years away. Okay, so if you wait for recession to buy shares, which is 1.5 years away, I would say you might be missing one of the greatest opportunity of a correction, right? So if you really like, okay, to know more about the stock market today, to prepare yourself, what if there's a bullish momentum in the second half of this year? I would strongly suggest you come to a physical seminar whereby I'm going to share with you what are some of the fundamental strong stocks that analysts, not me, analysts are highly recommending today. So I'll give you the report, okay? What are some of the strong fundamental stocks that analysts like today and are giving very high buy rating, okay? So I'm going to give you this list of stocks, okay? If you join this stock investing discussion, so it'll be a physical discussion, physical class, okay? That's when I can share with you a lot more things, okay? I can give you the report, okay? Number two, what are the sector and stocks to invest in a high inflation era? So there are some stocks that are really, really inflation proof, okay? So I'm going to share with you what are those sectors. And number three, why is the year 2026 the real recession year that I predict, okay? Of course, this is a bold prediction. I feel the recession that people anticipate, even if it happens next year, is not the real recession. Why? Because there's still strong buying power. There's still jobs around. The real recession will happen when the stock market reach an all-time high figure and the real bubble suddenly bursts. Suddenly bursts. So my prediction, it may be 2026. And it has got to do with property prices. It has got to do with property prices. So what is the cause of it? So I'm going to share with you through some research over a 200 years period why 2026 might be the year of the real recession. And how do you prepare yourself for this second half of the year? There might be a chance of a rebound in the stock market. Okay, so if you really like to know more, to help yourself to prepare, I do understand a lot of us already give up, but then again, the best chance to buy into a stock market is when a lot of people suddenly give up. And that, I do mean, is not only the stock equities market, but even crypto market today. Okay, half a year ago, believe it or not, I predict that Bitcoin will drop to $17,000. Okay, and we are near there already, right? Today is bordering around 20,000. Okay, so hopefully it dropped there, and that means that there might be a chance that is the real bottom of cryptocurrency. So I'm going to share with you why I think so. How do you prepare yourself for second half of this year? Okay, so if you like to join this seminar, it's very limited seats. Okay, because my so-called rented venue can only accommodate perhaps at most 20 of you. So please register your seats below. Please register your seats below through this web link. Okay. For English class, it will be www.dl-investment.com/en. Okay. For Chinese class, it will be www.dl-investment.com/cn. Okay. So please register your name, email, telephone number. Okay. So there's a limited seats of 20 packs. Okay, once 20 packs is up, okay, we can't accommodate you anymore. Okay, because there's a 1 meter apart distance. Okay, so thank you very much. Okay, I really hope that I give you a different view from what analysts are talking about today, from what people are predicting, even from what government tell you today. Okay, so instead of a recession, I feel that there might be a chance we'll avoid a recession. There will be a soft landing because of strong demand. Okay, strong demand. There's still a strong demand, and businesses are still continuing to be strong. Okay, so let's take a look. Of course, the confirmation will be in the next coming few quarter earnings to see how resilient are the stocks. Okay, in anticipation to the rising interest rate environment, as well as the high inflation era. Okay, so thank you so much. Today I wouldn't have the time to respond to your questions, so sorry for it. Hope that in future, whenever I have a Facebook gathering, hope that you can join us, and feel free to join our Facebook gathering in future. And thank you so much. Bye bye, and see you. Okay.